Imagine waking up one morning and hearing this from the bank: your mortgage interest rate is now 20%. That was exactly the shock millions of Americans experienced between 1979 and 1981. The American dream, the symbol of homeownership, starting a family, and building a future, was being shattered by an invisible hand in just a few years. The most painful part: nobody fully understood what was happening. And worse, this disaster was just beginning. At that time, America faced a reality that even today's youth couldn't comprehend. Buying a house had become a luxury only accessible to the wealthy. Mortgage interest rates, which had remained at normal levels for 20 years, suddenly began to climb. First 10%, then 12%. People tried to relax, thinking it won't go up too much, but the real devastation was at the door, because by 1980, the figures were pushing the limits of imagination: 18%, 19%, even 20%. In America, a 20% interest rate meant the gravestone of the dream of owning a home. But the truly shocking thing is, this wasn't just a financial crisis. This was a serious social earthquake targeting families, marriages, children's futures, and people's hopes. Because in America, nothing touches a feeling as powerful as the desire to own a home. For 30 years, everyone had grown up with the same expectation: if you work hard, you'll have a home. But after 1979, that sentence seemed like a lie. In those years of old America, people looked at each other and kept asking the same question: how can we pay the bank the price of 2 houses for one? There was no answer, there was no logic, and the explanations from the government, newspapers, and experts only confused people further. Because there was a hidden truth. This massive interest rate explosion was not the result of the ordinary citizen, but of a much larger war. It was at this point that everything was about to change, but no one knew how painful it would be. Suddenly, housing advertisements began to fill up like a garbage dump. Because people couldn't afford houses, those who bought couldn't pay, sellers were losing money, and even tenants were left helpless. Owning a home was no longer a source of joy but fear, and worst of all, interest rates weren't falling. They were rising day by day, and people with dejected faces were lining up at the doors of banks. Real estate agents asking who would buy a house with these rates were starting to close their shops. But the truly terrifying truth hadn't yet emerged. Even the banks were struggling to bear this burden. The mortgage market was the heart of the American economy, but the heart was now beating irregularly. So much so that even the government was slowly beginning to realize it was losing control. Why did interest rates suddenly skyrocket? Who triggered this crisis? Why were people caught so vulnerable? The answers will paint a much darker picture in the next chapter. And now we get to the main story. How did this interest rate tsunami occur? Whose fault was it? And by what invisible force were the American people squeezed in this way? If we want to understand the 1979-81 mortgage crisis, we must first see the bigger enemy America faced during those years: out of control, unbridled, persistent inflation. In the early 1970s, America still had a strong economy, but with the explosion in oil prices, the heavy toll of the Vietnam War, and a massive drop in consumer confidence, the economy began to crack. But no one predicted that inflation would grow so large that it would suddenly suffocate homeowners, farmers, retirees, and workers. Every day was more expensive than the day before. Someone going to the grocery store was already thinking, how much has the price changed today, before even leaving the door? And that's when one of the most insidious problems emerged. Wages simply weren't enough. But the truly shocking thing was, inflation in America wasn't growing due to a consumer frenzy, but like a self-feeding monster. Prices were actually rising because people thought they would rise. Psychology had taken control of the economy. This was the most dangerous kind of inflation. Right in the midst of this chaos, the Federal Reserve finally realized a huge problem it had ignored for years. The situation wasn't going to improve, it was going to get worse. And that's when a name entered the scene: Paul Volcker, a tall, serious, uncompromising man. As soon as he took office, he made everyone think, this man is going to do something. But what will he do? Even in the early days, the signs were clear. The country's middle class was being crushed. Working families were suffocating. The elderly were watching their savings dwindle. Young people were afraid to borrow, and companies couldn't invest. America couldn't breathe, and Volcker knew very well, if he didn't stop inflation, America would collapse. But what was truly shocking was that Volcker's plan would be one of the harshest economic treatments history had ever seen. Most people dismiss the 1980 mortgage interest rates reaching 20% by simply saying they raised interest rates. However, the mechanism at work behind the scenes was far more terrifying. Volcker was deliberately slowing the pulse of the economy to kill inflation. This was akin to the harshest intervention ever performed on a patient in intensive care, temporarily shutting down certain bodily functions to stop the shock. Credit taps were tightening, banks' lending costs were rising, and the money in the market was practically freezing. What was the natural consequence of this? Of course, a rise in mortgage interest rates, first 12%, then 14%, then 18%, and the final blow 20%. It was like an economic earthquake. The housing market came to a standstill. The construction industry collapsed. Millions of Americans had to postpone the possibility of buying a home for years. Some couldn't postpone it. Their dreams were shattered overnight. Yet only one question remained in everyone's mind. Would such a ruthless plan really work? Volcker's harsh measures had slowed the economy, impacted house prices, and shaken millions, but the real major consequences were yet to come. These decisions would completely change the economic spirit of America, affecting its future for decades to come. Now we come to the darkest and most emotional part of the story, the experiences of real people trapped in this crisis. But before we get to that point, we need to feel how those families were dragged into this darkness, because behind the numbers, the interest rates, the graphs, there were families who couldn't sleep at night, who opened their ledgers at the kitchen table, erasing and rewriting the accounts over and over again. Even before interest rates rose, household budgets were shrinking, inflation was gnawing away at everything. Shopping carts half full while bills doubled, stagnant salaries, children's school expenses, rising gasoline prices. Many families, even before seeing the interest rate disaster, had already begun to ask themselves, can we make the mortgage payment this month? But the real tragedy was that this problem turned into a completely different nightmare a few months later. In some families, the parents worked 2 jobs, some survived on small weekend jobs, and some started relying heavily on credit cards to cope with the sudden surge in expenses. And back then, credit card debt was a much heavier chain than we know today. And on top of all this, a rumor began to spread that no one had heard before. The Federal Reserve is going to significantly raise interest rates. A chilling shiver ran down the spines of millions of people who heard this rumor. Because everyone knew this, if interest rates rise, mortgage payments will increase. If mortgages increase, household expenses will spiral out of control. If household expenses increase, the family will fall apart. But no one could have predicted how big an increase it would be. Most people said, it'll increase by a few points, we'll manage. But what was approaching was a kind of devastation no one was prepared for. This uncertainty settled over the American middle class like an invisible fog. Families sat silently at the kitchen table, calculating. They spoke to each other with anxiety, though they didn't show it. What if interest rates rise too high? What if we lose our house? What if it affects our children's future? Those who felt the weight of these questions were not alone. Millions of households across the country experienced the same fear, the same tension in every home, every neighborhood, the same silence, the same waiting. Some nights, fathers would quietly go outside and sit in the car so the children won't hear. Some mothers would secretly close their budget notebooks, putting on a fake smile when they got up from the table. Everyone knew that if morale collapsed, everything would collapse. And all this psychological pressure was the first sign of a country teetering on the brink of an explosion. And then came the day that turned everything upside down. Interest rates didn't just rise, they jumped to the most shocking level in American history. No one could have imagined the devastation such an economic shock would cause for ordinary families. But with the announcement of Volcker's decision, for millions of mortgage holders in America, life was divided into two, before the decision and after the decision. Because from that day on, for most of these families, home ceased to be merely shelter and became an unbearable burden of debt. And now, in the next chapter, we will see how the 1980 mortgage crisis gradually shattered the lives of middle-class American families, how numbers turned into a nightmare, and the nightmare into the fate of millions. As soon as Volcker's interest rate hike was announced, an invisible earthquake struck the country. Mortgage rates first rose from 12% to 14%, then to 16%, and finally to a level history has never seen, 18 to 20%. Every homeowner felt a pang of anxiety, because this increase meant monthly mortgage payments sometimes doubling. For example, a $400 payment could suddenly jump to $700, $800. Considering the salary levels of that period, this increase was a knife plunged into the heart of family budgets. Some families couldn't withstand it in the first month. Some tried to hold out for 3 more months. But for many, a real disaster was beginning. But this wasn't just a monetary crisis. The real devastation was happening in people's souls. For a father who lost his job, mortgage payments were no longer just a debt. It had become a struggle to protect the family's home, honor, and hopes. Many fathers sat down at the table thinking, how am I going to tell them this? Mothers, meanwhile, tried to act as if nothing had happened in front of their children. Toy purchases were postponed, movie nights were cancelled, weekend picnics were put off until another time, and while all this was happening, foreclosure notices across the United States became the most crowded page in newspapers. Foreclosure signs were being lined up on the green lawns in front of the houses. In some neighborhoods, 5-6 houses on an ordinary street were put up for sale at the same time. The suburbs, a symbol of America's middle class, now echoed with the silence of fear. Neighbors looked at each other. No one could say it aloud, but everyone felt the same thing. Are they coming in our turn? Some families sold their cars to save their homes. Some cashed in their gold. Some put their children's college savings into mortgages. But one of the most painful moments was this. That night the mother sat at the kitchen table with the father and said, "There's nothing left to do," because that sentence was the beginning of a new life for the family. But this new life was not the kind anyone desired. It was at this point that the unseen face of the crisis emerged. Even those who hadn't lost their homes suffered as much as those who had. Because the pressure of mortgage payments had weighed so heavily on them and family tensions had risen so high, silent arguments began in many homes. Stress changed the atmosphere inside the houses. Some couples separated after this period. Some didn't separate for economic reasons, but they were emotionally exhausted, their life energy depleted. Children were also affected. While going to school, they wondered, will we have to move? Some didn't tell their friends. They were ashamed. Because losing a home at that time was like a social stigma. Meanwhile, the economy was also hit by unemployment. The crisis was straining not just mortgages, but the entire economic fabric. As interest rates rose, the cost of credit for companies also increased. Workers were laid off. Millions of people who were laid off experienced the mortgage nightmare even more severely, because high interest rates plus unemployment, inflation, an unbearable burden for any family. And that is why the 1979 to 81 period went down in history as one of the most traumatic financial periods experienced by the American homeowner class. And now, in the next chapter, we will see how this crisis fundamentally changed the American economy, what lasting marks it left on the mortgage market, and how its effects, which we still feel today, were formed. So, how did these painful years reshape the future of the financial system? The 1979 to 81 mortgage interest rate boom was not just an ordinary economic wave in history, it was a turning point for millions. A generation that dreamed of owning a home in those years experienced both financial and psychological trauma with this nightmare. Home ownership wasn't just about status, it meant security, peace, and a future. But when interest rates jumped to 20%, that peace was shattered. The impact of the crisis wasn't limited to individual lives. Public borrowing policies changed. the risk perception of banks providing mortgage loans completely shifted. The dream of owning a home was no longer pursued with 20-year terms. It began to be built on much more cautious, much longer-term plans. Banks began lending by taking into account interest rate risk and market fluctuations. The fixed-rate loans we use today were a result of this caution following the variable rate craze. But most importantly, that crisis taught economic management the harshest lesson. In a country, the housing loan system must be as robust and transparent as its monetary policy. Because interest rate and inflation controls determine not only the numbers, but also people's living standards, the peace of families, and the demographics of cities. Looking back today, the pain of those dark years is still remembered. But the real legacy is the national memory created by that era. America now knows economic security can be protected not only by profit, but also by planning, order, and coexistence. And if a young person today is considering a loan to become a homeowner, those who sign that loan must not forget the burden carried by a generation that lived through the storm of the 1980s. Because it's not life insurance, it demands responsibility. Thanks for listening. See you in the next video.